Okay, well, welcome tonight, everybody. My name is John Mazzara. Tonight I'm teaching the Twin Cities first-time homebuyer class. A little bit about myself. I've been selling real estate for almost 39 years. It'll be 39 years this summer. I started when I was 21, right out of college. And I've sold over 1,200 homes all across the metro area. I teach community ed and other classes. So I've done this a long time. I have a very extensive financial and real estate and mortgage background. So anything you want to talk about tonight, I'm happy to go there with you. We are going to follow a format with regards to the slides tonight. But if there's a question that comes up that you want to know more about or you want me to dig into, I'm happy to do that. So with that, I'm going to let one more person in. And let's go ahead and get started. Okay, so as a first-time home buyer, since you've never done it, do you feel concerned, stressed out, intimidated, anxious, uncertain, not sure where to start? If you have any of those feelings, that would be normal because until you've done it, you don't know necessarily what it's all about. You may have heard about it from your friends and other family members, but it can be a scary experience, and I want to make it easy for you. I want you to hit the easy button after tonight. So this is who I am. My name again, John Mazzara. I started selling homes right after graduating from college. I went to St. John's. I sold over 1,200 homes all across the metro. I sell, well, not right at the moment, but I had been selling for many years, one home a week. It's been a little bit slower the last 6 to 8 months, but that's normally the pace that I'm on. I work with buyers, sellers, and investors. I know the loan programs and the lenders. I work with a variety of different lenders and mortgage brokers, and that's what we're going to talk about tonight, is how you can find their best mortgage for you. And then once we get you pre-qualified, I'm going to help you find the right home if you are looking for assistance with an agent. So if you Google me, you'll find out a lot about me. You can read my reviews, learn about my background. And one of the first things we're going to do tonight is start out with where you can get some information about the marketplace in general. So I have a website. You can see it off to the left. It's MPLS, like Minneapolis, mplsrealtor.com. If you go to that website, that's an open site, meaning there's no password required to get in. And once you're there, you can click on the Market Data tab, and that's at the top. Once you click on that tab, then you're going to be able to drill down and do some research. Now, I wanted to give you a macro approach tonight, so I did the 13 county Twin Cities region, but we could do a micro look as well. For example, we could do St. Paul, or we could do a community like, let's say, Highland Park within St. Paul. So we can drill down to wherever you might happen to have interest. I'm going to call your attention to 3 spots on the screen. The first one is the median sales price. What we see here is that the median sales price from February to February changed from about 345 to 359. That's about a 4% increase. Smoothing that data over 12 months, we can see that it was about 1.4% of an increase in price. If we had gone back in time when interest rates were 2, 3, 4%, we were seeing homes appreciate at in excess of double digits, so more than 10% per year. Now, obviously, that was not and is not sustainable unless your salaries are increasing at that same level. Now, how many people are having a 10% sustainable increase in salary year over year? I didn't see any hands go up. So probably not too many people. And that's kind of where we're at right now, is with the interest rates rising from 4% a couple of years ago to closer to 8 right now, the average person has lost 40% of their purchasing power. So it doesn't mean you can't buy a home, it just means you can't buy as much home as you once were able to. And what that's done is that slowed down the hyperinflation rate that homes were appreciating at. And now this rate of, let's say, 1.4 over long term, 1 to 3%, that's sustainable, and that's keeping up with people's increase in salaries. So that's more normal. If we look at percent of original list to sale price, we see that homes are selling between 98 and 99%. What that means is that when a home is priced correctly, it'll sell very close to list price. So one of the things that you want to be aware of when you're making an offer is what is a realistic offer to make. And if you're seeing that across the metro, that homes are selling very close to list when priced appropriately, that's what you should expect. You're not going to get a huge discount, generally speaking, at least not initially. Normally, a home seller will try the market, and then after 30 days, if they haven't gotten their price, they're more open to being more flexible and even having a price reduction. What we're seeing on the last line with months of supply of inventory, there is a almost 30% increase in inventory from last year to this time. And that reflects, again, the slight slowing in the market. And the slowing is occurring because of the higher interest rates. People are, have a certain amount of uncertainty. And then, just general, let's say the 401ks or other assets that they have may not be responding the way they once were with, again, double-digit appreciation. So people sometimes feel uncertain. And what do you do when you feel uncertain? You don't do anything. And so that's sort of reflected on this chart. But you can go again and check different areas throughout the metro area and see what areas that you're interested in, how they're performing. You'll find in many cases they're performing the same as the broad area. Okay. What are the common steps to home ownership? Well, one is to come to a class and learn the process. We're going to go over what a pre-approval is versus pre-underwritten. Again, using a lender of your choice. Depending on what you're doing, you may be eligible for a conventional loan, a VA loan if you're a veteran, or an FHA mortgage. Conventional and FHA are open to everyone. A VA is only open to veterans. If you are a first-time buyer today, there are more down payment assistance programs than I have ever seen in my career. And again, I've been doing it a couple of years, almost 39. So down payment assistance is called the DAP. And we'll go over some of those here in a few slides. So once you get pre-approved under the loan program of your choice, with or without down payment assistance, then with your favorite realtor, you get signed up and you enter into a contract for representation. That realtor will set up a search for you where you can go and find homes that will match through the MLS what you're looking for. Then we'll go out and show you those homes. Ultimately, you'll pick one, and we may not get the first one we make an offer on, but ultimately we'll get one after we negotiate. And then you may get a home inspection, review the condominium documents if it's a condo or townhouse. Appraisal is ordered, title work is ordered. They verify that you're still employed, that your credit hasn't changed substantially, and your loan is finalized. We go to a closing, we sign for about 45 minutes, and now you're a homeowner. And then you get to plan which holiday you're going to host. So here you can see it again kind of graphically. I wrote it out with words before, but here you can see it with a picture. So you're here on step one to get educated. Then you're going to figure out what you can afford in your budget. Shop for a mortgage loan with a lender of your choice. Shop for a home, and that's something that I can set up for you. And then ultimately, if we're working together, we'll go out and we'll look at homes. And again, we'll find that right house. You'll probably have a home inspection. We'll finalize the mortgage approval, the lender will, and we'll go to that closing. Okay, so mistake number one that we don't want you to make is to ignore any of the incentives that might be available for you. First-time buyer programs typically work with the major lending institutions. So when you get a conventional loan, there is what they call government-sponsored enterprises, GSEs, known as Freddie Mac and Fannie Mae, and they're the entities that are underwriting and purchasing the conventional mortgage. They're the ones coming up with the guidelines. There's also FHA, which is the Federal Home Administration, and they also will work with first-time buyers or second buyers. Everybody here works with both first and second buyers, and they work with down payment assistance. In general, to be a first-time home buyer, you cannot have owned a home within the past 3 years. So one of the individuals that's on this webinar tonight, his wife owned a home, but he's married. So he also is going to be considered a homeowner, and he won't be able to utilize any of the first-time buyer programs because he is married and they are reporting it on their taxes. when you want to utilize a first-time homebuyer program, normally there's going to be some education. So it'll be like this, but it'll be through an online or in-person format, and you need to finish the classes, get a certificate, and submit that to the lender. Now, usually that takes about 8 hours. You can do those classes in advance, or you can do it during the purchase time frame. However, between the time that you buy and close, it's typically going to be 30 to maybe 60 days. And you're going to be busy with lots of other things. You may not want to have to figure out where you're going to get those 8 hours. Classes can be online or in classroom. The down payment assistance programs are each different. So whichever lender or program you utilize, you'll have to take that specific class. Okay, so different first-time homebuyer programs. I mentioned it earlier that they can be specific to a city or a county. Let's see here. I think somebody has their phone on. If you can mute, I'm catching a little bit of background. Let's see here. I may have to stop my screen share for a second and find out and mute. Oh, looks like everybody's muted now. Okay, let's go back to the screen share. Okay. Back to the buyer programs. So they can be specific to your city or county. It might be statewide. So the Minnesota Housing Finance Agency, affectionately known as MHFA, they have programs that you are eligible for regardless of where you are in the state. Almost all the programs for first-time buyers have income limitations and credit limitations. So if you make too much money, although they are pretty broad on the amount of income that you can make, but if you make too much money, you're not going to be eligible. Or if you have credit score, let's say below a 640, generally, you're not going to be eligible. The first-time buyer program, some are forgivable, some are deferred. Some are forgivable over time, meaning you have to live in the home for a period of years, 5 years, 10 years, for example, and then all or part of it will be forgiven. Some of them are graduated, so 20% a year for 5 years. And some are just outright grants. And sometimes you can stack them. So you might be eligible for more than one program depending on where the house is located. I had a friend of mine who's a loan officer do 4 loans for a woman to buy a home because of the area that it was located in. She had community money, city money, and then MHFA money and some other money. So by the time he was all done, he did 4 individual loans as part of the purchase. So some programs are stackable, some aren't, but just know that you might be eligible for more than one. Okay, so here's an example of how you could use the Minnesota Housing Finance Agency as your down payment assistance. Let's take a hypothetical purchase of $250,000. You're going to put 3% down, so $7,500, and finance $242,500. You're going to have closing costs of roughly $6,250. If you add them together, you're going to need $13,750 to buy that house. Now, that was if you paid for it all yourself. However, you don't need to. Under MHFA, if you have $1,000 of your own money, they'll borrow you the rest. They'll give you a second mortgage at the time of the purchase for the other $12,750. So you could buy a home with as little as $1,000 out of pocket. It's just a phenomenal program. This is the picture, or the flyer that I put in a picture for you from the Minnesota Housing Finance Agency. So that is their website, that is their phone number. You can find a lender that does the down payment assistance programs on their website. So not all lenders will do this loan. The big banks will, most of them, and so will some of the larger credit unions. But again, all of the people that can do these loans are listed right on the website, or you can call them and then they can help direct you, but you'll find it there. Or of course you can ask me and I can help make an introduction. Okay. Was there a question or was somebody just? Was there a question? No? Okay. If I could ask you to mute, please, and then we'll open up for questions in just a little bit. So this just goes over what the current guidelines are for Minnesota Housing Finance Agency. You can make up to $185,000 and still be eligible for this program. So again, it's not a low income program. They do have some programs that are, but this one is not. It's a relatively high income. And the larger your family size, the more income you can make. We have a question here from Shabu.
Yes. So I'm sorry for interrupting once again. My
Not a
question
problem.
is, does the down payment affect your the interest rate? The down payment assistance, does it affect the interest rate at all?
That's a great question. So the answer is, generally speaking, no, it doesn't affect your interest rate. However, there are certain places, like let's say Habitat for Humanity, that depending on the type of loan that you're looking to get in your family situation, you may be able to do a no interest or a low interest type of loan. There are some religions that don't let you pay or don't want you to pay interest. You can pay profit, but not interest. So there are, Islamic financing that doesn't have, I'm going to call it an interest rate. It does, but it doesn't. It's not called interest, it's called profit. So there's that type of product where, you might be eligible for, depending on the lender. So the Freddie Mac actually buys that loan from a company called Guidance, which is one of the leaders in the Islamic financing. So it's Sharia compliant loan. So there's that has an interest rate differential. But most of the time, the other programs, no, you're not going to get any type of interest rate break or charge if you use down payment assistance. And one of the things that's kind of interesting is on the purchase agreement, the seller doesn't know how you're structuring it. All they know is that you're buying it with, let's say, 3% down. They don't know that you might be stacking 2 or 3 different loans or programs to get to that 3%. So you're coming in when you present your offer the same as any other buyer that might be putting their own money down instead of using down payment assistance. So that's probably more information than you wanted to know, but that's did I answer your question?
Yes, but I don't want to cut you off, so I will just keep quiet until you're done.
Okay, no problem. We
Thank
are
you.
going to come up to a break in just a little bit, and then we'll open it up for more questions. So
Sure.
thank you for
Thank you.
bringing that up. Okay, so here's my lovely wife, Patty. So she works over at Wells Fargo. So that's one lender that I use. It's not the only lender. You'll see some more slides here in a minute, but they have something called Dream Plan Home. So if you bank at Wells, this is their specific product. Also, the nice thing about Wells, being that they're a big company, is that they have arrangements with large employers and with certain unions. They have something called the Union Plus program that they can utilize. And depending on where you work, if you work, let's say I'm just going to say 3M, but let's say you work for a big company like that, there might be an affinity relationship where you're able to get a $500 credit, for example, after closing. So there's some things that you get with some of the bigger lenders that you don't necessarily get with some of the smaller lenders. One of the things that you're able to get is proprietary programs because they're big enough to create their own. The smaller brokers have to find it elsewhere. The bigger banks can create it. And they go elsewhere too, meaning they go to Fannie, Freddie, and FHA and the Veterans Administration, but they create their own stuff too. So one of the things that's coming, and it's not quite here yet, I'd hope to be able to tell you that it's here, but it's coming. It may not be here now until June. We thought we'd have it in April, but it's called the First Gen Homebuyers Program. Now there's going to be 2 different versions, which you'll see coming up, but it's forgivable money over time, and you'll see that here in just a minute. If your parents had not owned a home or if your parents were foreclosed upon, and lost a home. So let's take a look at that next year. So another lender that I work with, like I say, I work with many lenders besides Wells Fargo. One of them is CMG, and you see Toshi here in the lower left, and she'll be one of the lenders that's able to do this program. There's going to be the Community Fund and Minnesota Housing. You see there's different amounts of money available. One will give you 10% of the purchase price, one will give you up to 35,000. And depending on, your situation, you may go one way or you may go the other way. But it's not quite ready yet, but it will be. And this will be a lot of money. You can see 1,500 loans on the one program and 3,000 on the other. That will help people purchase a home. And it's going to be partially forgivable. You see the loan forgiveness in the middle there? So it'll be forgiven. So a big opportunity. I helped an individual buy a home in St. Paul under the Rondo program. That's a program for individuals that may have been related to somebody that was displaced in the Rondo neighborhood. And the gentleman I helped purchase, he was able to get $90,000 from the city of St. Paul. So like I say, there's lots of programs. We just have to find one that matches what you're looking to do. Another program over here at Movement Mortgage, my buddy Preston. So let's say you needed to use FHA because you had a lower credit score and you didn't have really any money. Well, Movement Mortgage will lend you the money for the FHA down payment and part of the closing costs. So it's almost a no out-of-pocket deal, very inexpensive to get into a home. And so if you have that lower credit, that might be something that we end up utilizing rather than one of the other down payment assistance programs that requires a higher credit score. And these programs are available all throughout the city. So Edina, a lot of people think Edina is not affordable. Edina can be affordable. So Edina has a program called Come Home to Edina. You can get up to $90,000. It's 25% of the purchase price. I believe you can make up to 150 grand. And they have something called the first generation home buyer. So you see at the very bottom, you can get an additional $20,000 if your parents or guardians didn't own their own home. So Edina, a lot of people think it's not within their reach. It is. And that's just one example of one of the many suburbs that has programs. One of the interesting things, and I'm getting a little ahead of myself, but in the multiple listing service, under the actual listing of an individual home, there's a button, and that button says you click on it and it lists all the different home buying, first time buyer programs that home might be eligible for. So you don't have to know all of them off the top of your head. When we identify a home that you want to buy, we can also then look and see what programs might be available for that home. So what are the three types of mortgages that you can utilize with or without down payment assistance? One is conventional. And again, everybody is eligible. It's based on income and credit scores. FHA, everyone is eligible. It's based on income and credit scores. VA loans are for veterans only. Now, one of the types I don't have up here is called non-QM, which means non-qualified mortgage. So there is a fourth type. And that would be for something that doesn't fit within the regular conventional realm. Maybe you're self-employed. Maybe you're an investor. Maybe income is sporadic, up and down, but you average out at the end of the year. Maybe there's periods of unemployment. We don't know. But if something is a little bit unusual, there's a fourth type of loan that requires, again, a higher credit score and a larger down payment called a non-qualified mortgage. And we have outlets for those as well. So underwriting guidelines are given by the entities, the government-sponsored enterprises, Fannie Mae and Freddie Mac and FHA and VA, but a lender may put an overlay. So you may hear from one lender, we don't do loans unless you have a 640 or above credit score. That's their overlay. FHA, for example, it's possible to do a loan down to as low as 500 with a larger down payment, but not all investors will underwrite or buy that mortgage. So we're not going to do that at the bigger banks. We're going to do that through a mortgage broker. But know that there are options. If you can come up with a down payment and a reason why you might have had that low credit score, maybe it was a medical issue, maybe it was a business situation, maybe it was a divorce that was ugly, could be a number of different things. But as long as we have a reasonable explanation as to why it no longer is affecting you, and that you've overcome whatever that is, you may be able to get the loan out. We can even overcome a bankruptcy after a couple of years with FHA. Conventional is going to take maybe 5 to 7 years, but FHA between 2 and 3 years, we can overcome it. And even if you're in a Chapter 13, we can actually get that loan done. So what I always tell people is, let's have a conversation. Tell me what's going on, and then I'll see if I can't figure out where to point you in the right direction to get the financing. A conventional loan is a home buyer's loan that is not offered or secured by a government entity. It's a quasi-government entity. It's a government-sponsored enterprise, but it's not part of the government. As such, you have to go ahead, depending on your down payment, get private mortgage insurance if you don't put 20% or more down. With FHA, you're going to have to put more, you're going to pay mortgage insurance, but with a conventional loan with 20% down, you won't. FHA, or a Federal Housing Administration loan, that requires mortgage insurance. All lenders can originate these loans. And the reason you pay mortgage insurance with any loan is because of protecting the lender against your default. So the lender is in the business of lending money. They're not in the business of owning real estate. They don't want your home. So if you don't make the payments, you don't get to stay, and they do something called foreclosure. The reason they're willing to lend money with only a 3 or 3.5% down payment is because there's insurance covering them for that default if you default. A benefit of an FHA loan is you can purchase a home with as low as a 3.5% down payment with a 580 credit score. What you'll find locally here is many lenders have an overlay that requires a 620 or a 640. Again, you can go down to as low as 500. There are not as many lenders that will take that loan, but there are some, and they're generally going to require a 10% or more down payment. With an FHA loan, the seller can pay up to 6% of the closing costs. Now, I said they can. I didn't say that they would. So depending on the home that we're buying, we may be able to ask for certain seller concessions, one of them being closing costs, which would offset that cost to you. Or we may be able to work it into the transaction by increasing the purchase price by the amount of closing costs that we're asking. So there are some creative ways that we can figure it out. FHA, a lot of the times, has a lower interest rate than some of the other types of mortgage products that are out there. And they typically allow a higher debt to income ratio. When the programs are underwritten, they put the information into the computer. So you fill out a loan application, you put your income, you put your debt in, and then based on that, the computer says, this looks like a reasonable risk, or it doesn't. So it's kind of like a black box. Information goes in and an approval comes out. Then that loan is underwritten based on the information that was inputted, and it has to match up. And if it doesn't, well, then you could be not approved. So the purpose of getting fully underwritten versus just an online approval is that everything has been vetted. So that's the route that I'm going to recommend that you go. It's going to take a couple of extra weeks up front, but it'll shorten the process on the back end, and it'll make you a stronger buyer, because when you make your offer, the seller knows that you're good to go. FHA works with down payment assistance programs, grants, and again, FHA will, but not all the lenders are able to do them. So you need to work with a lender that is working with down payment assistance and will underwrite on that basis. Here's kind of a comparison grid between FHA and conventional. A little bit more down with FHA, a little lower, or actually a lot lower credit score is potentially acceptable with FHA. The debt to income ratio really depends on your income, your credit, and your assets. The more assets you have, the stronger the file is going to be, and the wider or the larger the debt to income ratio is going to be allowed. The loan limits are smaller for FHA in Minnesota. These are the numbers. It's larger in certain areas like Hawaii and other areas like California, but in Minnesota, these are the max loans for this year. There is no income limitation. You can make $1 million or more and take out an FHA loan if you want. So there's no like first time buyer qualification that you are going to be disqualified at. Minimum out of pocket, that depends. And it's going to depend on, let me get back to that. Depends on where you're getting your funding from. So it could be down payment assistance, can be a gift. Some people will take the 401k loan and use that as a down payment. That's very popular with conventional loans and for FHA. Although we tend to see gifting more popular with FHA and with conventional, maybe not as much. First-time buyers often lack the money. So where do you get the funding? Well, we went over the $1,000 program from the Minnesota Housing Finance Agency. Gifts are allowed. We have to get a bona fide gift letter from a parent or a relative. And that means we have to have them sign a letter saying this money is indeed a gift. And then we have to source it, meaning we have to get from that parent or relative a copy of the statement where they took the money out of. It can't be from a credit card. A lot of times people will use 401k loan. If you work at an employer and you fund a 401k, you can take out the lesser of 50% or $50,000. Then you pay yourself back over time. If you have an IRA, you can take $10,000 out of that, use that to buy a house. There won't be a 10% premature distribution penalty if you're under 59 and a half, but the full 10,000 will be taxable to you as income in that year. And the seller can pay closing costs if you can work it in the transaction, which will then eliminate that portion of the purchase. So remember, we're going to need a down payment and we're going to have closing costs. Under most loan programs, the seller can pay a portion of the closing costs. With FHA, it's 6%. With a conventional loan, it's 3%. With VA, it's 4%. Here's what you can't use for a down payment: borrowed money in any form. So for the purposes of your purchase, it's a gift, it's not borrowed. You cannot credit card advance and use that as your down payment. And you can't take a loan from anybody other than a loan provided by the lender or a down payment assistance program. That's the word DAP. And it can't be undocumented cash. So some people transact in cash and might have a box under the mattress. You can't go ahead and come into the closing with $10,000 cash or any cash for that matter. It has to go through the banking system. And so if you do have cash, because that's how you prefer to operate, you want to introduce that into the banking system, into your checking or savings account, so it can be documented and verified at least 2 months prior to your loan approval process, because they're going to look at a 2 months average balance, and they're not going to want to see zero, and then $10,000. We're going to have that money in there for a couple months before they don't come back and need a letter for documentation. A buyer's eligibility is based on your underwriting review, and this is why credit is so important, because how do we know how you're going to pay if we don't have an example of how you've paid in the past? So that's your willingness to pay. That's your credit history. Your ability to repay is your income. So sometimes people say, well, I can afford X amount of a house payment, but if it exceeds 50%, and usually it's around 40, between 40 and 50% of their income, they're setting themselves up for failure. So the banks don't want, again, to foreclose, so they won't let you borrow more than they think that you can repay. The home itself is the collateral for the loan. And so the home has to be in reasonable condition should they get the home back that they can sell it, that the bank gets it back. So that's why you're not going to be able to buy with a regular loan a fixer-upper that's not in decent enough shape to get a loan. Sometimes you've seen some real scratch and dents and you're like, well, I can fix it over time. The bank won't lend on that with a regular loan. Now, there are some rehab loans, but they won't lend it on it with a traditional loan because the home isn't collateral ready. It's not in good enough condition. Okay, let me open it up for a couple minutes for questions and answers, and then I'll keep moving on. Does anybody have a question that you'd like to ask on what I've covered so far? Becky?
Hi, does the FHA loan work for someplace if you're going to do a standalone home that you want to rent? Or is it only if you're going to reside in the location?
Yeah, great question. FHA is for owner occupants only initially, which means if you live there and then you have a change of circumstances, you move because of a job or life situation, or you don't like the house anymore, then you can turn right around and rent it. So what we don't ever want to do is commit mortgage fraud, which means we need to represent the way, what our true intent is. So if our true intent was to owner occupy at the time of the purchase, that's a snapshot in time, and that's how the loan is underwritten and given. However, if you never really intended to owner occupy and you said you did, then that's mortgage fraud. And it just so happens in Minnesota, if you go down Highway 100 and 694, there's kind of a nondescript, maybe 5-story building that's kind of gray and black with black wire fencing around it with pointy fencing all around the building. That building is the FBI mortgage insurance or mortgage fraud headquarters. So they're right in their backyards. Not that, they don't go all over the United States, but they're certainly close enough that they could check you out if they wanted to. So I would strongly discourage you from misrepresentation. A lot of people don't think they'll get caught, and then they do, and then not only will they call the note due, but then they can prosecute you. And that does happen. It really, really does.
Is there a minimum for if your circumstances are on the fence or possibly changing? Is it 6 months to show that you've been living there, or is there any sort of time frame?
Yeah, there is not. So I'm gonna say, let's say you got a job offer to go work in Florida. You closed your home, and a week later, all of a sudden that dream job came up, and you don't want to sell your house because you just closed on it. There's no equity in it yet. So you're gonna rent it and move to Florida. So you could do that. And you could actually get another FHA mortgage in Florida because you're far enough away that you could do that. So no, there is no timeline. I'm gonna say it has to pass the smell test. So I would give you my non-legal opinion would be a year would be the best if you don't have a life event that you can point to. So, I got married, I got divorced, I got a job, a new job, whatever it might be. If there's something like that, you could move in a minute. But without a life event that you can point to, I would say a year of owner occupancy would be the safest, in my opinion.
Okay, thank you.
You're welcome. Any other questions? Sunny?
Yes. Yeah, I have two questions
Sure.
to ask. Yeah. So, my question is, is it the broker or the loan officer who is going to help you get the grants or the assistance that you're gonna need?
Does the loan officer do that?
I'm just asking, is it a loan officer who is gonna help you get the
Yes,
down payment assistance or a broker?
both. So a
Okay.
broker is a loan officer. So let's take let's
I'm sorry, I mean the realtor.
okay. So the realtor, like myself, we have access to the programs indirectly through the multiple listing service underneath the listing itself. So if you pulled up a home, we bought the home, I could say, this home is eligible for MHFA, it's eligible for the North Side program, so on and so forth. But I'm not the one as the agent, I'm not the one lending the money or involved directly in your loan process. So if you told me you wanted to live in a certain area, I'm gonna then suggest that we work with a loan officer right off the bat that can do loans in those areas. Not all loan officers have the ability to do loans in all areas of town based on the down payment, using a down payment assistance program. They have the ability to do loans, regular loans, all over town, but they're not all approved. So like if you go up, for example, if you said, John, I want the 18,000, up to 18,000 MHFA program, then we need to use one of the lenders that can do that program. And those are listed on MHFA's site. Now, I could give you the name of individuals that could, both brokers and people that work at banks, that are eligible to do that MHFA loan. So if you wanted to go to, I'm just going to call it small bank on the corner. Small bank on the corner probably cannot do MHFA. US Bank can do MHFA. So if you said, I want that program, I'm going to suggest that we utilize a lender like that, somebody that's approved.
And then do they tax the 401k if you are using it for your down payment?
Do they touch it?
Do they tax the
Tax it.
401k? Yeah,
Got
do
it.
they tax it?
If it's a loan, loans are not taxable. If it's a distribution, then it's going to be a hardship. And if you don't pay it back, then yes, that will be taxable. Most people take the money out via a loan and they pay themselves back over 7 years, 9 years, whatever the maximum length of time that your 401k custodian allows for. That's typically what somebody will do. So there is no tax. You just have to pay yourself back through a payroll deduction, each week or every other week or however that works.
Okay. What about can you still have FHA and then go for the HELOC?
Say again, please.
Can you still have a FHA loan and go for HELOC?
Can you do an FHA loan and a HELOC?
Yeah.
They're two separate things. So yes, you could. So FHA, you're going to buy with a 3.5% down payment.
Mm.
Now, if you're using Minnesota Housing Finance Agency as with their purchase second, that is a second mortgage. It's not a HELOC.
Mm.
It is a second lien, but it's not a HELOC. If you buy your home with FHA and your home appreciates and you have enough equity, then you can take out a HELOC. Most banks that are giving HELOCs allow you to take a loan up to 80%. So if your FHA portion of the loan represents 70% of the value, then you'd be eligible for 10% in the form of a standalone HELOC with another bank that would do that loan.
Mm.
That makes sense? And
Yeah.
to me, it makes sense because I do this every day, but I know these are all new words for everybody.
Yeah.
Any other questions, Sonny?
For now, no. Yeah.
Okay. And then Becky, I see you
Thank
have your
you.
hand up. You betcha.
Yeah, I just had a quick one. Can you do an FHA loan if you have a co-signer and the co-signer already is a homeowner?
Yes. So that happens frequently where a parent, for example, will help and co-borrow with a child or, their son or daughter or whatever, and help them buy. So yes, you absolutely can do that. You're qualified as a rule of thumb for roughly 4 times your income. So if you made 100,000, you're eligible for 400,000 in aggregate loans. So your income will only take you so far, meaning if you're a homeowner and you're already maxed out on what your income allows you to qualify for, you won't add any value to a cosign or a co-borrow. However, if you still have room left because you can still qualify for more, then you'll be value add to that mortgage cosign.
Okay, thank you.
You betcha. Shelley, you have a question?
Yes, so I currently live in Georgia and I own a townhome here for 3 years now. And I'm moving to Minnesota in a few months.
Okay,
So my fiance, we're planning on buying a home together.
sure.
So I'm guessing I don't qualify as a first-time home buyer, even though it's in a different state.
Correct. You don't, but he might or she might. So that person would qualify if they don't own a home. as a first-time buyer. And if you're not married yet, you might be able to have that person utilize their first-time home buyer status, and then you could move in, after the fact.
So we won't be able to apply together.
Well, you could, you just won't be a first-time home buyer if you do. But it doesn't mean
Okay.
you still can't buy a house. You may need to do it that way if you need both incomes to qualify. So if the other person doesn't make enough to qualify for what you want together, then you may have to forfeit that first-time buyer status and come together on the application, and combine income and credit to get what you need.
Oh, okay. Okay, thank you.
Okay, you're welcome. Shelley, question?
No, that was it.
Okay, Sani, a question?
Yes.
Okay.
So I heard you saying so if I purchase a house now, that means let's say I have a duplex and then a 4-bedroom duplex that I purchased. So is it possible for me to rent out a 2-bedroom while I'm living in a 2-bedroom, or unless I stay in the house for a full 1 year before I can rent it out? I can rent the 2 bedrooms.
If you own or occupy a duplex, which you can do with FHA, with as little as
Hmm.
3.5% for a down payment,
Hmm.
5% down for conventional, you can rent out rooms in your house, as long as you're living there.
Okay.
It's a duplex, so you can rent out absolutely the other half or other
Oh,
side.
okay.
Day
So
one,
okay, thank you. Is there any possibility that if you have like you can get a four bedroom with I don't know, and I just want to be clarified. Can you get like a 4-bedroom with 2 kitchens in both kind of uh apartment, like, but in a duplex? Is it possible?
a duplex is generally set up that way. So you have either up, down, or side by
Okay.
side. And
Oh,
each side is a fully functional separate unit, meaning they're going to
oh,
have
okay.
their own bedrooms, their own kitchens, their own
Mm,
everything.
okay.
Typically, the utilities are also going to be split, meaning you're going to have a separate furnace, a separate water heater, separate
Hmm.
electric. Under most duplexes, not all of them, but under most of them. What you might have that's common to you both is the laundry in the basement. It's more unusual to get a separate laundry, but
Mm,
everything else is separate.
all right. Thank you so much.
You're
This
welcome.
really helps me.
Wonderful. Ariel, you have a question? Um,
Yes.
okay.
Can you hear me?
Yes, I can.
Okay. I'm Shirley's fiance.
Okay.
So as she explained before, she's living now in Georgia. I'm living here in West St. Paul,
Sure.
and I'm working in Mendora Heights. So uh, that will change if I apply as a first-time home buyer. And this is my question. I think I have it too. So you say I can qualify, right? And there is some change in the amount of down payment, saying like I just have an IT number.
Okay. So you have an EIN?
Yes.
Okay. So
Is there any information regarding that one?
yes. One of my lenders, not all the lenders, will do EIN loans. So I don't know that you're going to be eligible for some of the down payment assistance programs
Okay.
with your EIN. So what I would say is we would get you in front of a couple of lenders that are doing those EINs, and then they would then check based on where you think you want to buy, utilizing the down payment assistance specific to that area. So if you said, well, I don't care anywhere in the metro area, that might be the Minnesota Housing Finance Agency. If you said, I want to be, in Edina, then we need to check and see if the City of Edina program allows for EIN. So the answer is it'll be more limiting, but you will be able to get a loan. You might have to put a larger down payment down. But like I say, I know a couple lenders that will definitely do that with an EIN. I just don't know the complete specifics of the limitations.
Yeah.
But it can be done. Absolutely.
Okay. Thank you.
You're welcome. Any other questions before we go to the next half? Okay, well, let's take a look at what we've got next. Okay, mistake number 2, not getting a pre-approval before you view homes. So we covered what the pillars of a mortgage approval are: credit, income, and down payment. And a pre-qualification determines how much that you can spend. And of course, we wouldn't want to start shopping until we knew how much you could actually spend. So we don't even go look at houses until the mortgage part is complete. Any seller, when they look at an offer, needs to know that you can complete the transaction. So we don't make an offer and then try to find the money. We make an offer knowing that we have the money, or we meet the guidelines of the programs in place, and then we make our offer. And then we start our shopping. So the first step is, after we sit down and have a conversation, is to get you in front of a lender, have you make an application, have you go through the underwriting to the extent that you can be fully underwritten. Now, not all lenders will do full underwrites. The reason being is they have to pay an underwriter, and if you never close a mortgage, they're out $650 or whatever the approximate charge is. Lenders like Wells Fargo have underwriters on staff. So if you ask to be fully underwritten over there, they'll underwrite you. Other brokers can't afford to pay to have you underwritten, not knowing if that loan is going to close, and they can't charge you for that. So it's their loss if you don't close. What they'll do is an automated approval, which means they'll look at the guidelines, they'll look at you, and then they'll say, yep, as long as things don't change, you fit all these guidelines, you will be approved. That's a loan approval versus a fully underwritten approval. Remember, the underwritten approval is going to take a little longer upfront because you're providing all of your documentation. But once it's done, it's done. There aren't going to be any snafus unless something that you did change, meaning you took out a new car loan or you paid late or something like that. But assuming you still were the way at the time of the purchase that you came into the procedure, you're going to be fine. So the pre-qualification is basically after our first meeting, that is the next step, is to get you financed and ready so that you can buy when the right home should appear. Okay, tips for simple loan approval. Call us if you have any questions. Continue to live at your current residence. Continue to pay your rent or mortgage on time. Continue to use credit as normal, meaning don't go out and make any big purchases. Keep working at your current employer or in the same line of work. So let's say you were a nurse. You could be a nurse at Fairview Southdale, and then you could be a nurse at Abbott Northwestern. No big deal. But let's say you wanted to go be a self-employed business owner from having worked at a W-2 employee. That's a problem. That's not going to work because the mortgage company doesn't know yet what you're going to earn. So you're going to set yourself back by a year or two if you move into self-employment. So we don't want you to do that until after you've closed on your loan. Remember that when you're underwritten as a snapshot in time. So this is how my income and credit is today. This is where I live today, or I plan to live. Life can change, and they can't take the loan back from you once it's given to you. So we need to make sure that the way you're underwritten is the way that you complete the transaction. You will be asked for documentation. So part of getting a loan is providing documents. So it's going to feel maybe a little bit intrusive. I have to give a social security card. I have to give bank statements. I have to write letters of explanation. You have to do all of these things. So other than blood and urine, it will be somewhat of an invasive process. So expect that, but that's how it is for everybody. And that's how the lenders make a solid loan, is they have to underwrite it, and they can't underwrite it without that documentation. Some of the don'ts: don't make any large purchases that could affect your debt ratios. Don't have large influxes of cash into your account that's unexplainable. If you sold a car or a motorcycle or something, that's fine. But if there's all of a sudden $10,000 in the account that wasn't there before, we have to explain and document where that money came from. We don't want to start transferring balances or closing any credit cards. If we close credit cards, we actually don't have that credit anymore. And if we don't have that credit, then our utilization, meaning the amount of credit that we're using on other credit cards, actually goes up in percentage to our overall available credit. The higher our utilization, the greater risk we are, because we don't have as much room on our credit. So we could get in trouble quicker. We don't necessarily want to do any consolidation also during the loan process. If anything, we want to pay our debt down. We don't want to increase it. We certainly don't want to have any late pays or overcharges. I covered this just briefly: underwritten pre-approvals versus pre-qualifications based on automated underwriting. We always want to get underwritten if we have that option. Again, depending on the lender, not all of them are going to be able to underwrite. And some of them, like the down payment assistance programs, they only underwrite once they have a, accepted purchase agreement on a specific property. So if we're utilizing some of the down payment assistance, we can get underwritten on the first portion of the mortgage, but not necessarily on the second portion. Again, and that's so important, because once we know what your max is, then we know how much we can spend. We don't have to spend it all, but we know how much we could go up to. Once we have it, then we can set up your search. You know what you can buy, I know what you can buy, and we base our search on that basis. We have to submit that letter at the time of the offer so the seller knows that you can get the transaction completed. Typically what will happen is when we make an offer, the listing agent will call the mortgage person and verify that yes, indeed, there aren't going to be any problems. So I always do that on my listings, because I don't want my seller to have taken the home off the market and lose marketing time and have the deal fall apart. I want to vet the lender, the program up front. Mistake number 3, picking the wrong lender. It can be very expensive to use the wrong lender if you're planning on using down payment assistance programs. Remember that not all banks or brokers have access to all of the down payment assistance programs. So if there's one that you want to use and your bank doesn't offer it, or your broker, you may have to switch in order to take advantage of that program. About 2 years ago, or 3 years ago, I guess, I had a client that wanted to use their credit union that they had been using forever. However, their credit union did not offer any of the first-time buyer programs. So instead of using $1,000 in MHFA, which they could have done, they waited a year to save up the 3% for the down payment. However, homes appreciated 10% in that year, which means that home that would have cost them $300 a year ago now costs them $330. So waiting, if you don't have to wait, can cost you. And using the wrong programs, if the lender you're working with doesn't offer the program, they're not going to tell you about it, because they're going to tell you what they offer. That's why working with somebody that knows what's out there, like myself, somebody that's been around for quite some time, can help make introductions for you to different banks and mortgage brokers that might be able to help. If you're doing it on your own, which you're welcome to do, then I would encourage you to do the research on the program that you want to use and make sure your lender can provide it. So it's all about balancing your situation with the right loan product and then finding the right home. So the question is, sometimes, should I get a 30-year fixed mortgage? Well, the answer is maybe. And it's a maybe because it depends how long you're going to be there. So the individual that's coming here from Georgia, maybe they're going to be in Minnesota for, I'm going to say, 5 years. And then the intent is to move back to Georgia. Well, why not look at the rates on a 5-year ARM or a 7-year ARM and compare that to the 30-year fixed? Because if the ARM is cheaper and you're not going to be here beyond 5 or 7 years, then why take out a 30-year fixed rate that's more expensive that you're not going to utilize? Same thing on a first-time home versus a second home. So if you're like, well, I want to buy this home, to build some equity, but I know I'm going to move out of it within the next 5, 7, or 10 years. It's another reason why you would look at getting an ARM, because you're matching the mortgage product to the length of time that you intend to own that house. What if you want to buy a home that isn't quite perfect? So it's got some dings, it's got some blemishes, it needs some work. Maybe it needs a new kitchen, a new bathroom, a new furnace, a new roof. Maybe it needs all those things. There are special loans that you can take out that allow you to borrow the money to do the rehab. One of them is called the FHA 203K. There are 2 versions of that particular loan. Conventional loans also have a rehab option where you can take out money to borrow to fix the house. Now, other than those 2 types of rehab loans, you're not going to be able to buy a home that's scratch and dent. You can't use hard money on an owner-occupied property. And a regular loan needs the collateral to be livable. And so if the home isn't livable, then you can't use a rehab loan. But you could use a rehab loan to do some remodeling too. So it could be completely financeable with regular loan. However, you want money to do the rehab. Maybe it's in the area you want, the school you want, but it has just an atrocious kitchen. You might be able to borrow the money through the 203K, finish the kitchen, do a new one, and then you move into the house that you want, the area that you want with the new kitchen. There also are affinity programs. So I mentioned that briefly. If you're in a union, there's a program called Union Plus. And if you work for a large employer, your employer may have a relationship with a large lender that gives them a special deal. There are also special programs by the larger lenders generally where they create their own mortgage products that they keep in their own portfolio. So they follow some of the other guidelines that are out there, but they get to make the rules. And you may find that that product or program provides you something that nobody else did. So it's worth learning about. And that's one of the things with that Wells Fargo product, the Dream Plan Home, that's their product. That isn't anybody else's. So if you want to learn about that, you need to speak with somebody at Wells. Your lender and your loan officer needs to be a counselor and needs to give you options, understanding what you're looking to accomplish, and then matching the product. This industry is complicated, and you could look online and say, well, who's got the lowest rate, or who's got this or that, but the people that are selling based only on rate don't oftentimes know about the nuances of the product. And I affectionately call them rate quoting monkeys because they aren't skilled. They just can quote rates. They don't and can't advise appropriately. So I'm going to encourage you to work with somebody that has a broad selection of product and that can act as a counselor to help you pick the right loan for your situation. Mistake number 4 is to buy from a builder without having a realtor present. So when you work with a builder, which advertises through the multiple listing service, we can take you over there and show you and sell you that home. If you work with the builder or you work with somebody like myself to represent you, the cost is identical. You won't have any cost savings working directly with the builder versus working with the agent. So since the cost to you will be the same, why wouldn't you want to have representation? So an agent like myself can set up and show you all of the homes that are being built new that are advertised in the MLS and help you compare builder to builder. We can also make suggestions on lots, floor plans, color selections, all of those things that you might need some guidance on. And the cost will be the same as if you did it directly. The one thing about working with a builder that's a little different is that they request that we bring you over to the property and register you upon your first visit. So if you wanted to buy new construction, and again, you're going to see these when we set up your MLS search. If you want to buy one of those homes, just let us take you over there first. Then you can come back time and time and time again. But they're very strict on having us register you there because they want to know that we were the ones that actually were responsible for introducing you to the product, i.e. through the MLS, and that it wasn't just the sign on Sunday, or whatever. So they want to make sure that we were part of it, and how we show that to the builder is by bringing you over. Sometimes what we'll find is that closing costs may be offered in exchange for a higher rate, which could cost you more in the long run. So we always have to make that comparison. So what I'm talking about is if we walked into Builder A may have a mortgage company subsidiary, and they may say, if you use our mortgage company, we'll give you $10,000 in closing cost credits. That might be a good deal if the interest rates are the same as what a regular lender would have charged without the $10,000 credit. However, if the rates are higher, then it's not a savings because they've just given you a higher rate to give you the credit back. So that's again where an agent like myself can help you make that determination. So agents work for you. The sales agent in the model works for the builder. Realtors add value to the process. So I would encourage you, if you're looking at new construction, to have representation. A realtor is knowledgeable about what to look for, inspections, final walkthrough, and upgrades. So again, the cost is the same. Why wouldn't you? Mistake number 5 is skipping the home inspection when it might make sense and when it might not. Okay, so the first thing I'm going to tell you is I will never tell you to skip a home inspection. I'm going to tell you the pros and cons of why you would and why you wouldn't. It's your choice, always. If we're in a multiple offer situation and it's you and 3 other people, if you make it without an inspection, then you've removed a contingency, because what is an inspection? An inspection is a contingency because that allows you to either renegotiate or walk away. Without the inspection, that doesn't allow you to do that. So if I'm a seller, I've got 3 offers on the table. One is with an inspection and 2 of them aren't, or reverse it, either way. I'm going to look more favorably upon the offer or offers that don't have inspections. So if I feel confident in the home, let's say I'm knowledgeable or it's a newer home, I might waive an inspection. Now, because I've been doing this every day for 39 almost years, I would feel very comfortable for myself waiving an inspection. But I'm not encouraging you to do it because you haven't sold 1,200 homes. So I'm going to encourage you to learn about your home and to have a home inspection. But I will tell you, in a multiple offer, that may be a deciding factor, and it may cause you to lose the home. The risks of skipping a home inspection are as follows. You'll be unaware of deal breakers or money bombs. An inspector will find problems. Sometimes they exaggerate them a little bit, but nonetheless, they're there to find problems. That's what you're paying them to do. Pick my home apart. And sometimes they'll find things that we weren't aware of and help you avoid getting caught with a big expense down the road. If you skip a home inspection, you won't be able to come back to them later, the seller, and say, well, you should have told me, unless it was fraud, meaning they knew it was a material and they should have told you. But if there's something they didn't know about that later you found out about, you can't come back and say, hey, I need you to fix this, because you chose to pass on the inspection. You risk inheriting non-structural safety issues. A big one can be sewer lines. So let's say we're looking at homes in Minneapolis or St. Paul, or a first-tier suburb around Minneapolis and St. Paul. Many of those homes are 75 years or older. Many of them have the original sewer lines. Over time, they can get intruded upon by roots or, dirt collapsing and different things, and the sewer lines can fail. To dig up a new line from the street might cost $12,000 to $15,000 or more, depending on the length of the run, what they have to do. But you won't know if you don't run a sewer scope. And so that might be one of the best tests that you run on an older home, about $250. But if you determine that it's bad, the seller, you would tell the seller, and the seller can't sell the home to anybody else without full disclosure. So indirectly, you've kind of put them in a box. You've kind of forced them into fixing it because nobody else will be able to buy their home until it is fixed. Another thing about a home inspection is I call it getting to know your home. Doesn't mean that the seller is going to fix everything. It's an older home. But at least you know what you're in for your future budgeting for costs and improvements. There also might be things where people didn't pull permits. Very common not to pull a permit to finish a basement. Maybe people got together with their buddies or their relative. Maybe they did it correctly, maybe they didn't. So you're going to not have that opinion if you don't have a home inspection. And again, you'll have limited recourse, because what you're saying when you buy a home without an inspection is, I essentially accept the home the way that it is. So caveat emptor, which means buyer beware in Latin. Number 6, skipping the condo document review. Some of you may choose to do a condo or a townhouse purchase instead of a house. Minnesota law allows for 10 days for a complete review of the rules, the regulations, the bylaws, the financials, and the resale disclosure certificate. You can go to the Attorney General's website. Under publications, there's a button, and you can print it. And I'm going to show you that here in the next slide. By mutual agreement, it is possible to shorten the 10-day timeline to 3 days. You don't have to do it, but a seller may request that you do it and say, hey, hurry up and review the docs, because they want to move on and either buy another home themselves or put the home back on the market if you're not going to buy it. So it's not uncommon to be asked to shorten the 10 days to 3 days. You have to agree to it, because by law you're given the 10, unless you agree to shorten it. So here's what you're going to get from the Attorney General's office. It's about a 4-page document that goes over the rules and regulations under associations. And there's a number of other publications that are very valuable. So I would encourage you to put your tax dollars to work, head on over to the Attorney General's website and click on the button for publications and see what might be useful to you. Once we've determined what you want to buy, where you want to buy, and how much you can buy, then we set up the search. And this is what it looks like. So we go into the MLS, we register you, and then we put what you're looking for, coming soon and active, with the minimums. So I'm looking for 3 bedrooms, 4 baths, 3-car garage, between 400,000 and 500,000 in Eagan, Apple Valley, and Burnsville, for example. So we pick the area, and then we set up the search. You're sent 2 emails. The first one is from the system with the baseline of homes that are currently available for sale. Then you set up an account, it's free. And then you click on, I want to acknowledge and receive new homes. So you have to agree before the system can continue to mail or email you, because otherwise it's considered spam. So there's a couple of steps. I'll walk you through them, but you get the search set up, and then it drips on you every day as new homes that meet your criteria become available. So one day you might get 3 listings, the next day you might get none, then you get 2, then you get 5, so on and so forth. So you're matched to the minimum criteria of the homes that you're interested in. And when you see one that you like, then you let me know, and we go out and we look at it. We typically do them in batches. Like this Saturday, I'll be showing between 2 and 3 homes to an individual. We can go out individually if there's only one, but we typically will batch them and go and look at more than one, if there is more than one, all at the same time, just for efficiencies. And then if you like something, we'll look at making an offer. We'll do some research, see if it's priced accurately. If you're interested in down payment assistance, we can see which programs might be eligible for that house. And then we write up an offer, and hopefully we're not in multiple, so you don't have to compete. But if you are, I will give you guidance on how to win that, should that occur. I have just a ton of resources for you that I make available. One of them is a flip book and a hard copy. So this is a hard copy, paperback. Or if you go to this website, you can read it online as a flip book. Here's what's in the book: owning versus renting, needs and desires, getting that first home loan, first-time home buyer programs, common first-time buyer mistakes, searching for the right home, 12 steps to buying a home, hiring an agent or buy a loan, do's and don'ts of negotiations, what to know about home inspections, the closing process, and moving tips for the first-time buyer, and real estate horror stories. That's what's in that book. I have another PDF. It's called Building a Case for Home Ownership Today. Talks about why owning is generally better than renting and how you build wealth. If you look at the way people typically build wealth, it's through their retirement plans and the appreciation of the equity within their home. So it's a tremendous wealth builder over time under most circumstances. So how do you feel now? Hopefully excited, confident, more informed than when you started about an hour ago, and ready to get started. So how do we get started? If you would like to book a time to meet with me, go ahead, take a snapshot of this. This is my Calendly link. You'll pick a day and a time. I will call you back and confirm that that time works. If it doesn't, we'll pick a different time that does. We can meet in person, we can meet via Zoom, or we can talk on the phone. So I work in Edina. I have an Edina office. I work out of the Woodbury office as well. Or I can meet at another location within RE/MAX Results. RE/MAX Results is the largest RE/MAX franchise in the world. It's about 1,400 agents. We have over 20 offices all throughout. And so we can definitely find a spot that's convenient for us both to meet at and do a search and get you set up. So I'm here to make home ownership, or to tell you that home ownership is possible. Let's talk. Let's figure out what we need to do so that you can get ready to buy a home. Is it credit? Is it income? Is it employment? Are those things already in place? What do we need? Do we need money for down payment assistance? We'll figure it out. So here's what the Calendly link looks like. You pick a day and a time. It's gonna automatically be an accept, but then I'm gonna call you back to confirm or not confirm once I get your schedule, because my calendar isn't 100% synced with the Calendly. So I will follow up with you once you do that. There is no charge to meet with me, and I would love to be a resource, and I would love to be your agent. Of course, we work with everybody under all circumstances, all situations. Like I say, I've been doing this a long time, and I would love to call you friend and help you get your next home. If you would like a travel certificate, a dinner certificate, or a hotel certificate, and you want to take a 7-question, 2-minute or less survey, you could take a snapshot of this QR code, and that will let you, it's a jot form, it'll open up, and you answer 7 questions, and then you get to pick what prize that you want. One of them that's very popular is a trip to Vegas. Now it's a travel certificate, and there are costs associated with activating it. So you pay the room taxes and the hotel fee, but there's no cost for the certificate. So the certificate is free. The cost to activate it and use it does have a cost associated with it, as do the other two, the dining certificate and the hotel. So just know that it's a certificate, but there is some cost if you use it. There is no timeshare presentation. Okay, and that's me. So take a picture of that. Take a picture of the Calendly link and my website. And then I'm going to stop the share. We're going to open it up for questions. Okay, are there any other questions that came up for anybody that I can answer for you?
If I'm buying home, my credit or payment not, I cannot afford it. My wife can be co-sign.
Uh, I think you said if you can't afford a home, can your wife co-sign?
Yeah, my wife can be co-sign.
Okay, well, your wife would be a
Yeah.
co-borrower with you. So we could take your income, your debt, your wife's income and her debt, and together you become one on the loan application. Now, you had mentioned that she already owns a home, so depending on her income, she might not be able to qualify for any more home herself. I assume you're buying after, or you're keeping your current home. If you are selling your home, then that'll free up the availability of her ability to qualify. So you'll get whatever equity, meaning profit, you'll get that from the sale. And then she'll be relieved of the old mortgage and be eligible for the new mortgage. So let's say you owe 200,000 and you sold that home. She's now eligible for her 200,000 again because your other home and your other debt has been taken care of. Does that make sense?
Yes, sir. Her home is already rent somebody that she can be fine again.
Her home is being rented right now.
Yes, sir.
Okay. Where do you folks live then now? Are you renting?
She owned it at the Arizona Phoenix.
She owns it in Arizona.
Arizona Phoenix City.
She owns it in Phoenix.
Yes.
Okay. So that could help you. It depends on what she's renting it for. She might be in a positive, hopefully a positive cash flow situation, which might be additive to your income and overcome a portion of that debt on that mortgage. So we'd have to see the lease, we'd have to see her obligation on the mortgage and what you're reporting on your taxes. So you're going to definitely want to be underwritten and make a loan application with the lender and be fully underwritten with your income, your debt, her income, her debt, and that rental property.
Yeah, we yesterday we also at the test service. At the test service also we had to show the income for the rent
You'll have to have
money.
documentable income, yes.
Yeah, that's all. You mean I can be applying fast home buyer?
You're not going to be a first-time home buyer because you already own a home, your wife does. So forget that. You're not going to be eligible for a first-time home buyer program
Oh,
because you're married. If you're not married, yes, but you're married.
yeah, before you told me I'm not obligation to pay. That's why I can be home buyer before you.
Okay, you might or might not be obligated. I'm not sure how you took out that loan in Arizona. Typically, what'll happen when you're married is you'll sign the mortgage and she'll sign the note. That's what I think happened, but I am not, I from the webinar here, I don't have enough information to comment further on that, but you're not going to be a first-time home buyer if you're married and she's reporting that house on her taxes. So that much I'll tell you. We'll need to get you in front of a lender and have the lender ask you more of these questions because I'm not the lender, but we'll need to get you in front of a lender.
Okay, thank you.
Are there any other
By the
questions?
I wanted to take picture your address and phone. I cannot take picture.
Sure. Let me go back and share the screen.
Thank you.
Okay.
Another with your photo. And that's yeah, yeah. Hold on. Okay, thank you so much.
Perfect. You betcha. Other questions? Sani, did you have a question for me? I see your hand up.
Yeah. So my question is, can I buy a house now and after 5 years decide to sell it? Can the equity go high for me to be able to sell it after 5 years?
I'm sorry. Can I ask you to repeat that one more time, please?
Can I buy a house now after 5 years or 6 years decide to sell it?
Can you buy it now and sell it in 5 or 6 years?
Yes. Can I do?
Oh, 100%. There are no prepayment penalties. You can buy a home today and sell it tomorrow if you want. You won't make any money, but you can buy a home. There is no time period that you need to be on for a buy or a sell.
But what I mean is that do you think the equity will be high by 5 or 6 years time?
Oh boy, that's $1 million question. Here's what I'll say is that real estate, the cost of replication, labor, land, and material typically goes up. The cost of building always is getting to be more, and homes typically appreciate over time.
Mhm.
It all depends on where we're at with the economy. So I'm going to say if we look at history as a past reference, other than that strange window of time, which was 2007 through 11, other than that strange time, homes have typically appreciated. However, double-digit appreciation rates are not likely, and I would not count on that. I would count on 1 to 3%, and I think that's going to be undershooting the actual amount, but then you won't be disappointed.
That
For
is in
first-time
5.
home buyers.
It doesn't matter if you're a first-time home buyer or a 10-time home buyer. It's the function of the house itself and the area. So,
Mhm.
and appreciation is oftentimes determined by, you know, what you bought it at, if you got a good deal, and crime in schools. So areas where schools are good and crime is low, typically will have better appreciation than where it's just the opposite.
Thank you.
You're welcome. Shelley, did you have a question?
Yes. So the house in Georgia, I'm gonna be renting it.
Okay.
So what would be the minimum of the contract that I need to make?
You have a townhouse, correct?
Yes.
Okay. Under Minnesota, many of the associations here require that you sign with a year lease. So I would say you have to look at your association documents and see what they allow. Most people don't want to move 6 months, and most associations don't allow for short-term rentals. Most people want to sign a year lease, and that normally is the requirement, is a year lease.
Okay. And once I rent out the home, let's say my mortgage is 1,000 and I'm gonna rent it for 15. What percentage of that 15 is gonna be used towards my income that I can use for future purchase?
How much? Okay, sure. Typically, they're going to use about 75% of the income that you're generating. However, I don't know that they're going to use anything initially because it hasn't been put on your tax return yet. So what they like to see is history. So once you've had it for a year on your taxes, then you have history. Until then, we don't know if you're going to make money or lose money. I mean, you do have a lease, but it's not on your taxes yet. So I don't know that for the first year you're going to get any credit on that purchase.
Okay. So let's say with my fiance we decide to buy the house together, even though we're not gonna qualify for any of the first-time home buyer program.
Sure.
Let's say we're ready to buy, but we have the income requirements, but we don't have all of the down payment. Would we still be able to get like a second mortgage for a down payment?
Okay, the one program that I showed you with Movement Mortgage,
Mhm.
where they with FHA, where they'll lend you the down payment, and a part of the closing costs, that might work. The Dream Plan Home program might work. What we'd have to do is find out from the lenders what the actual guidelines are, because you're not going to be a first-time buyer. He is going to be a first-time buyer, but we need both your incomes, which means that you're not a first-time buyer. So some of those programs that would have been eligible, you're not eligible for. So the answer is we're going to have to check.
Okay. Yeah,
And
that's all.
your fiance is the one with the I-10, correct?
Yes, correct.
Yeah. So that's gonna be another restriction on what we're gonna be eligible for. So, yeah,
Okay.
we can do it, but it might require a down payment and a portion of that down payment to be his or yours, or both of yours, and not borrowed money.
Okay. So once I put the house to rent, let's say in June or July, when would be how many months should I wait before I start or before we start to like apply for houses?
Oh,
Is
I would do it
there a
right now.
time frame?
I do it now. I would get pre-approved now. And
Okay.
if the lease, if it turns out that your property has to be leased for a year, or whatever the criteria might be, then you'll know that upfront. And then when you write your lease, you'll get it written accordingly to minimize the impact of having that mortgage exist. Um, are you sure you want to keep a rental in a different state and not just sell your property in Georgia and move your equity up here?
No, I don't want to sell.
Okay.
Okay, that's all. That's all the question I have.
Okay, perfect. Anybody else have any other questions? Nothing else? All right, well, I'm going to stop the recording.